to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Russell Price, chief economist at Ameriprise Financial, to discuss that the Fed will finally pause in the near term and what the debt ceiling means to the economy and markets. Russell, it is great to have you with us. Welcome to Trade Talks.
Thanks very much for having me.
You got it. We're finally getting some data that shows a broader slowdown in the economy beyond just the housing market. Retail sales were down the last 2 months of 2022. Manufacturing activity has recently been contracting, and a growing list of companies are announcing layoffs. So are we in a recession or on our way to recession? And if so, how deep do you think it could get?
Yeah, I don't think we're quite in a recession at this time. It usually takes about 6 to 9 months for Federal Reserve interest rate hikes to fully affect the economy. And recently, as you mentioned, we've seen the declines in retail sales and manufacturing activity, and more recently, the services sector. So I think that we're finally starting to see the fuller implementation of those higher interest rates on the economy. But as of yet, I still think that we're not quite in a recession. We still may get there. We see the odds as just over 50%, but as of yet, I think the economy still is in a period of expansion.
If consumers are in good financial shape, how does that affect the outlook?
Yeah, consumers are always the most important fundamental factor when it comes to U.S. economic health. You know, they account for 70% of economic activity. Historically and quite logically, consumers, when they're deep in debt, the economy tends to slow or contract soon after. But when they're in good financial shape, the economy is well supported. The current good standing of consumer finances, consumer debt levels relative to their incomes are very low. Consumers have quite a bit of money in the bank and savings. That suggests to us that any recession that may come should be relatively mild, and any rebound that we see on the other side of a recession should have pretty good fuel.
So, Russell, what would a mild recession look like? How high might the unemployment rate go? And would the stock market see new lows?
We believe the unemployment rate should rise, but not to particularly worrisome levels. Last month in December, the rate was 3.5%, matching its lowest level since 1969. We believe that it could go a little bit higher, but still remain relatively well contained, and we see it remaining below 5%. We've seen some high-profile layoff announcements, but generally they've been concentrated in a few sectors, such as high technology, large technology companies, and financial services, where the stock market weakness has been a factor. But in general, we think that unemployment rate will remain relatively low. The stock market we see is ending this year as up. At our target, our price for the S&P 500 is 4,300, which implies approximately 8% from where we are today.
Right, which is reasonable when you look at historical averages. Will the recent slowdown in macroeconomic activity be enough for the Fed to finally pause over the near term? What do you see in terms of your outlook for Fed policy and when the first rate cut might come? Because to your point earlier, it doesn't sound like they're going to pivot course that quickly, considering it does take 6 to 9 months for these policies to really have an impact.
Yeah, we think that with their next meeting, which is the announcement will come on February 1st, we expect another step down to 25 basis point hike. We think that they'll do one more 25 basis point hike at the time of their next announcement, which is after February 1st meeting, which will be March 22nd. And at that time, in March 22nd announcement, we think that they'll announce a pause in their rate hiking cycle. We don't expect the first rate cut to come until probably the first half of 2024, unless inflation declines more broadly and at a faster than expected pace. Right now, economic weakness is the Fed's secondary concern. They want to make sure that they fully contain inflation before worrying about revitalizing the economy.
Is Fed policy currently the primary driver of market behavior? Do you think we'll see a return to fundamentals in the near future?
Well, I think it goes a step below that to the underlying problem, which is still inflation. Markets are responding on a daily basis to the information we get as far as inflation trends. And Fed policy is going to remain reactionary to inflation as well. So I think that's the appropriate reaction function right now. is to watch and see what inflation trends are doing, and the Fed will follow those trends most likely.
Right. Will inflation rates continue to decline over the months ahead? And what are the problem areas that might keep it sticky at higher than desired levels?
Yeah, we expect aggregate inflation rates such as the consumer price index or the Fed's preferred personal consumption expenditure price index. We expect them to decline at a fairly fast pace over the first half of 2023. The declines that we expect are partly based on the continuation of some price easing that we've already seen in many categories over the last few months, but also in the first half of this year, year-over-year inflation rates should get some help from difficult year-ago comparisons. What I mean by that is inflation shot higher at a quick pace in the first half of 2022. So the prices that we get here in the springtime in 2023 will be compared against those higher price levels of a year ago, thus reducing the percentage change at a faster pace. But for most goods and services, I think it's important to stress, we're not looking for absolute declines in prices, but rather softening in the pace of price increases. By year end, we still see the consumer price index to be about 3%, and the Fed's preferred measure, the core PCE index, just under that at about 2.5%. Energy prices are going to be more volatile and could offer some influence either way. Of course, wage inflation can be sticky and lag the broader inflation trends. So that's an area that we're watching very closely as well.
And of course, what about the debt ceiling? Does that offer any risk to the economy or markets?
The debt ceiling debate certainly has the potential to alter or affect economic and market sentiment, especially if it goes down to the wire, which unfortunately it could. The longer that we go without an agreement on the debt ceiling, the higher market anxiety levels are likely to go. But so long as the limit is raised in a timely enough fashion, that is certainly before the United States government defaults on its obligations, we believe that generally it shouldn't have any lasting consequences on financial market behavior. It's a very low probability, but certainly a very high risk scenario.
Right. And so to tie this all up here, right, you said that we may see a recession this year. We could see a few further rate hikes. Most market forecasters say we could see a further decline in corporate earnings. So why should investors stay in this market?
Yeah, that's a very good question. It's primarily related to timing. Keep in mind that financial markets tend to look 6, 12, or 18 months forward. So it may seem counterintuitive, but historically, financial markets have begun to recover long before a recession is complete, or there's been a resumption of growth in corporate earnings. For examples, the stock market bottomed in early March of 2009 during the financial crisis, but the recession did not end until that summer, and corporate earnings didn't start to grow again until the fourth quarter of the following year. So additionally, the early stages of market recovery periods can be oftentimes when you see the largest gains in the stock market. So as the old saying goes, I think it's the key to investing success is time in the market rather than time in the market.
All right. Excellent point. We appreciate the insight, Russell. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.